Hi everyone, welcome to our next session on international funds. Now we'll be covering two very important funds, and we have seen a lot of questions around our Greater China Fund and US Tech Fund. To cover the first part, which is our Greater China Fund, we have Alex with us today from JP Morgan team. Welcome Alex, how are you?
I'm great, thank you. I'm just feeling huge regret. I'm not with Darrington, but that day will come very soon.
Right. So let's going, Alex, and I'm sure the slides are up, and you will, answer as many questions a lot of our investors have today. To start with, past 1 year has been fairly volatile for Greater China region, and investors have seen a lot of volatility. Could you just share your views on what has been the key drivers behind this?
Okay, of course, I'd be very happy to. And let me thank everyone for your time today. It's hugely appreciated. So I think really the first thing we need to accept is that Chinese equities are a volatile asset class. And it's worth just setting that out up front, because we need to manage our expectations that this is not a low volatility investment opportunity. But what it is an opportunity where we think that over time that volatility will be more than offset by the gains we can make from it. Now, specifically to the last couple of years, let's go back almost exactly 2 years, which will be the left side of this chart. And COVID-19 emerged on the world. And of course, that resulted in a huge clampdown, not just in China, but in India and really in everywhere. And the way that the government responded to that was to conduct very substantial stimulus. Now, I would say that the stimulus out of China was actually more moderate than the stimulus we saw from some of the developed market central banks. But nevertheless, there was a major push on the monetary, on the fiscal side to get GDP up to recover from this. And a bit like many parties, then the next year, 2021, we had a bit of a hangover from this. So we saw a compounding of the economy slowing, and this was partly given the extremely high growth rate in the previous year. The government had accepted the slower growth rate in return for a more sustainable growth rate, and so they were squeezing certain sectors such as real estate, which is quite deliberate. And they also were worried about this a K-shaped recovery, which you will have heard about, which is to say that the rich get richer while the poor suffer. So asset owners were doing quite well out of appreciating equity values and asset prices, whereas people in the gig economy or informal labor were suffering at the same time. And China, a communist economy, was worrying about this. And so the regulatory environment also got more stringent. And behind all of that, of course, we've got ongoing geopolitical tension, which I'll be very happy to discuss. And this is sort of bubbling away in the background. So if we put all of that together, last year then was a more difficult year for Chinese equities, partly for reasons which China can't control, such as geopolitics, and partly for reasons which were very much within its control, which is to say tighter regulation and a squeezing of an over-leveraged real estate market. Well, that all then got compounded earlier this year when something beyond all of our control took place, which is to say the Russian invasion of Ukraine, which of course has been a dampener on growth and at the same time has pushed up commodity prices, particularly energy prices, which has been negative for margins. And so the question now is, what happens next? And I think we will come on to answer that. But really, this is the ride we've all been through. These are the circumstances of the last couple of years, which, as you say, have been, they've been keeping us all busy, shall we say.
Thanks, Alex. And as you mentioned, it's been an eventful year for Chinese equities and a lot of regulatory changes. So how has the portfolio manager responded to these changes, how the portfolio is aligned or changed over the last couple of quarters? And can you take us through some of the interesting themes or stories in the portfolio currently?
Yeah, I would love to do that. Thank you. So I think the first thing to say is that a lot of what the regulator has been doing is maybe more logical than you would think from just reading newspaper headlines. And I would counsel you never to invest on the basis of newspaper headlines. And so the regulatory moves have been more logical, targeted, and consistent than some people give them credit for. So, for example, clamping down on monopolistic behavior from companies with very big market share, that's not something which is remotely unique to China or the Chinese regulator. We've already seen that in many Western markets. So we need to understand their motivation. The next thing comes around portfolio construction, risk control, which is to make sure that our capital or our clients' money is invested in the areas where we've got the most confidence over the outlook and understand the red lines that the regulator sets on social and political agendas versus some of the other things. But the other thing to say is that actually, at the same time as there are these challenges, there are also some substantial tailwinds in the Chinese equity market, and we lean into those, as the expression goes, to make sure that we're benefiting from the more positive elements of what's happening. By the way, you might not always read about them in the newspapers because, of course, newspapers don't like to print the positive news, but it does exist out there. So let's go on to the next slide, please, as an example of that. Now, geopolitical tension between the US and China will persist for a long time. And I say that with great certainty because we're going from a world which has been dominated really by one superpower to a world with more than one superpower. And that makes the existing superpower, the US, feel somewhat uncomfortable. And so they will keep pushing back at China as China gets wealthier and more powerful. Now, one of the ways that China is responding to that is to become self-sufficient in a variety of technologies and areas which previously they used to import. And semiconductors is one example of this. So if we go back 10 or 15 or 20 years, China was not a player in the semiconductor market. Now, not just as a function of demand, but more excitingly of innovation and patents and intellectual property, China is able to do things and to provide not just goods, but also related services, which simply weren't possible previously. So we've been adding to tech hardware around a variety of different areas. And this might be things like parts of the, to do with industrial automation. It might be some hardware which sits behind renewable energy, which is something we'll be talking about later. Over time, we've had exposure to components of smartphones, et cetera, et cetera. But there's just a wide range of tech which will actually benefit from geopolitics rather than suffering on the back of it. Now, another example of an area which has got a following wind, shall we say, is on the next slide. And this is solar power. Now, if we go back about 5 minutes and I said that China is accepting a slower growth rate, but in return for a more sustainable growth rate, there are various elements to that sustainability. One is, for example, balance sheet sustainability, which is why they've been more aggressive with the real estate sector. But another area of that sustainability is environmental sustainability. And China will accept less growth, but they want less pollution at the same time. And so solar power is a really good example of an area which we know is important for all of us, but also has got in essence, the backing of the Chinese government. And there are many different ways we can play this up and down the supply chain. So it can be in the solar power companies, in people who supply certain chemicals to solar power, certain components. And there is an array of different opportunities here. So we have Tongwei on this slide. And then I think for my final slide in this session, if we can go on to the next page, please. Another example is in EV, which is to say electric vehicles. And electric vehicles sit at the confluence of two very powerful forces. The first is what I've just mentioned, which is the government wants this to happen. But the second force is that, thank goodness, the younger cohort of Chinese consumers who are coming up through the ranks and who are in a position now to buy vehicles, they are also more concerned about their carbon footprint. And so China is already the world's largest market for electric vehicles. We know that Chinese people will buy more cars in the future than in the past as they become more prosperous. We know that people want to travel. We can also see that they want to buy less polluting vehicles with help from the government. And so here again, we look up and down supply chain, typically not buying the brand owners so much as buying people who supply the brand owners. For example, China's largest battery manufacturer for electric vehicles, which also supplies internationally. And CATL, it doesn't matter to them which brand gets the most market share, because if they're supplying to all of them, then they will be benefiting. A little bit, I think the expression is like shovels to miners. Doesn't matter who the miner is, as long as you're providing them the shovels, you will do well. So this is another area that we have been positioning towards.
Right. So very interesting stories, and I believe there's a lot of secular themes, and I'm hearing this for last 2-3 years, which means most of these are secular stories. What's happening on the economy around the world is not changing the underlying growth trajectory, or a lot of positive for these themes. So quite interesting, Alex. Thanks for sharing them. But my last question to you before we move on to audience question is what is the road ahead? Whatever bad news was there, is it an end to that, or what's your view, at least in the near term, for?
Of course. Well, great question. And I think the first thing I'll point out is the point you made about these themes being unchanging. And that's an incredibly important point to raise. Because if you are a short-term investor, then I don't think this is the product for you. I'll be very, very open about this because I want to make sure that everyone's expectations are appropriate. We don't know what will happen next month, and we don't know what will happen next quarter. What we do have very high conviction in is that the Chinese economy in 5 years' time will be meaningfully bigger than it is now, that there'll be certain areas of the economy which have benefited as a result, and there'll be certain companies which will be providing to those areas. So by design, we take a longer term view because that's where we think we can add the most value and do the most thorough analysis. Now, having said that, what's the path we think over the next year or so? And if we can go to the next slide, please. There are lots of boxes on this page, or lots of, I don't know, lozenges. And really the path to focus on is the top one, please. So the Chinese government has come out in this politically sensitive year, and they have said they want a 5.5% growth rate. Now, the Chinese government, like many other governments, doesn't like to be wrong about these things. And so what we're quite confident on is that they will do what they can to get to that growth rate using whichever tools are available to them. One of the things which we don't think will happen is a mass easing of restrictions around COVID. And I've been speaking to my colleagues in Shanghai just this week, asking them how they are and what's going on there. And the strong consensus is that the zero COVID policy, whether you agree with it or not, is not going away. But if we accept that there is a zero COVID policy in place, and if we accept that China needs to achieve its 5% growth target, then the missing pieces are basically regulation, some degree of geopolitical easing, hopefully, and stimulus. So we don't have a huge amount of certainty over the path of COVID. We do know that the government wants a 5% growth rate, and so we can be pretty clear about what it takes to get from A to Z. And that's on the next chart, please. So what the government needs to do is to push on two things to stimulate. The first is to boost demand, and the second is to ease supply constraints. And if you put those things together, then the economy will be stronger as a result. So on the demand side, we've got things like fiscal stimulus. And as I mentioned earlier, China, although they stimulated in 2020, was more restrained than many Western governments. And so there is space there, and we'll talk about it a bit more on the next page. And we've also got monetary stimulus. And this is super interesting because although the RBI has been very cautious over the last year or so, more generally, the trend is for central banks to be raising interest rates, but not in China. China has been cutting rates, or they've been cutting their RRR rates since late last year. And we're seeing more generally an easing of some of the things they put in place last year while they're stepping on the brakes. And this can be things like the availability of mortgage financing, for example. And then on the bottom half of this page, in terms of easing supply constraints, well, this is where we think that the toughest days of the regulator are behind us. Now, that doesn't mean that regulation will go away altogether, because China has a lot of regulators and they regulate. That's their job. China is a centrally planned economy, and again, we need to accept that. But that doesn't mean that they're equally as tough all the time, and it doesn't mean they always focus on the same sectors. And so we think that they will take a more benign view on regulation. We've already seen some easing of computer game approvals, for example, in the cybersecurity space, because that is a controllable and necessary step towards getting the growth rate that they want. So we think you'll see fiscal stimulus, monetary stimulus, and regulatory easing. And I love the fact that this is counter-cyclical at the same time as so much of the rest of the world is looking to tighten. That's diversification 101. And then on to my final slide, please. If we just dig a little bit deeper into some of these concepts. Well, the fiscal stimulus you can see on the left is going to manifest itself in certain ways. I mentioned real estate earlier, but another important area is infrastructure. And as opposed to being the old-fashioned Chinese infrastructure, which is really big, heavy roads and bridges, we think more of that will be in smart new economy infrastructure, making sure that the internet is world beating, making sure that they've got the right logistics and that everything can be just on time. And on the right hand side, well, we've mentioned regulatory action. I think just a cessation of what's been happening there would be very positive. And in our portfolios, we've been concentrating our capital in stocks where we see the best upside from this point. And there's a food delivery company called Meituan, which would be an example. They have seen a little bit of action recently because the government is pushing back on the fees they charge to restaurants to deliver food at the same time as the pandemic is ongoing. But we do think that will ease in time, and then we can take a step back, look at their competitive position, their growth potential, and that's an example of a stock which we think has got real upside from here. So those are some of the things that we're doing in our portfolio.
Thanks, Alex. We have one very interesting question. The question is around China valuations. And if we compare China valuations with anywhere in the world, they're probably at a very discount to their maybe average or peers. So what is the reason for that? Of course, we have seen some volatility could be the reason. Your points on that, and how do you look at these valuations compared to the growth prospects? Do you have any numbers, maybe at the portfolio level or at the benchmark level, on the future estimated EPS growth on China market?
Okay, well, I'm not sure if you've got slides there that I put in the appendix too. There's a slide a couple of pages forward, which will, this is encouraging, which will show us what the expected return is like on our own proprietary measure. So let's go one more slide. Let's stay right there, please. You're in exactly the right place. So we have a proprietary measure of the 5-year expected return of the stocks that we look at. And the key drivers of those expected returns for our portfolio holdings in China are around the earnings growth rate over those 5 years and the exit multiple. And what you can see here is that 5-year expected return is really as high as it's ever been. To be clear, this is not a valuation measure. So for valuations, the higher they are, typically the more expensive they are. This is the opposite. This is the return we can expect from our companies. Now, the reason they're looking quite cheap is because China has been clamping down while a lot of the rest of the world has been more relaxed in this respect. And so it's acting in an idiosyncratic fashion. It's acting in a counter-cyclical fashion. The benefit of that is it means that I think they've set themselves in a better position for upside from here than maybe some other markets. And that's really not all in the price. The key for us is to be very, very clear about our earnings assumptions then. Because if we're wrong on the earnings, then we'll be wrong on the valuation as well. And around that, to give you a bit more color on some of what we've been doing, we've been taking down some of our consumer discretionary exposure recently because we can see the cost push inflation. And we know that there's a relatively soft demand environment just for the moment because of lockdowns and COVID. And so that means there's margin compression. But we've been redeploying that capital into areas like tech hardware, into solar, and to some other spaces like that. Maybe a few more financials, which are beneficiaries of some of what's going on here. So I think that the key as ever is to be very selective, to be very rigorous in your fundamental research, but also to be quite unemotional and to accept that we do see China in value in China, in a way that was less evident maybe a year or two ago.
Right. Thanks, Alex. Another interesting question is around the attribution. So while you explain what has hurt, which specific sectors have hurt the performance over the last 1 year in the China fund? And is the portfolio manager exiting or exited those names or those areas in the portfolio?
Sure. Okay, that is an interesting question. And the answer is that the attribution has come from a couple of areas. One thing is that as we see a risk-off environment and as we see US rates going up, inevitably we see valuation compression for long duration assets. So another way of saying that is you get companies who've got more of their value out far in the future. They will suffer relative to companies who've got a lot more visible value now. And this is what's driving this rotation from growth to value, not just in China, but across markets through Japan, through the US, through Europe, etc. And so that has been a detractor. So some of the stocks that we've held in technology or in healthcare have suffered on the back of that. We've also seen the regulation extend not just from e-commerce and other areas of internet to healthcare. And so that has also impacted some of the stocks that we hold. And then also, it's not always, of course, what you hold which can hurt you, it's what you don't hold. And we are very clear that we want to stay away from some of the big state-owned banks in China. They've got low profitability, they're not particularly efficiently run. We are not top of their list of stakeholders, they are at risk of national service. But as we've seen rotation through markets, they have outperformed them because we didn't hold them. Then we have had some detraction as a result. As for what we do about that, the key is to go back, look at your numbers, take an unemotional view on valuation, and decide on your next steps. So for things like healthcare, where we've seen geopolitical tension and regulation both feed into the weakness, there we have consolidated our positions or our bets, in inverted commas, into the stocks where we think that the valuations are most attractive and we've got most conviction on the outcome. In solar, typically we've been adding, as mentioned, and so we're much more confident in that, at the same time as taking some money out of consumer stocks, some of the staples, but also some discretionary names where travel, for example, won't recover anytime soon in China. And we're also just revisiting our conviction on the banks. And if I speak to the PMs, they're not going to start buying low quality banks just because they've been outperforming. So we're not going to change our position there, but maybe at the margin, we'll have a little bit more money in sort of real estate sensitives or some stocks in that space, which we think will benefit from the easing. So we don't go back on our fundamental conviction. We just test our views and make sure that our capital is deployed in the areas where we've got the strongest conviction and the best risk return trade-off.
Thanks, Alex. And I won't let you go without asking this very, very important question, which we keep getting. So when we look at data, whether it is from Chinese companies or Chinese economy, how reliable these data points are. And you, because we have partnered with you, we are quite comfortable with JP Morgan team being there on ground. So can you just let us know how the JP Morgan team is structured and how do we go about researching the fundamentals about China and the stocks before we picking and creating a portfolio for our fund?
Of course, and it's a very reasonable question, thank you. So the first thing to say is that the more we can do ourselves, the more comfortable we are. And so we have a very, very robust proprietary research team. We have 16 analysts based in Greater China, so either in Hong Kong or in Taipei or in Shanghai. Between them, they cover about 630 Greater China names, of which around 300 are A-share, so in the onshore market. They all speak Mandarin, they can all read and write. When the borders are open or when things are more relaxed within China, they travel, they see companies. And the more that we can do ourselves, the more comfortable we are. Then, of course, we've got our portfolio managers, Howard and Rebecca, who are both still fluent, etc., based in Hong Kong. And they're working with those analysts to make sure that we've got the best possible portfolio construction. We have a very, very rigorous research framework in China. And what we don't believe is that somehow you should treat Chinese equities differently than, say, an equity in a different market. We look at the same fundamentals, we look at the quality of the business, we look at the risk profile, and we look at the expected return. So there are no special rules. But also, of course, what we need is just to make sure that, to your point, on data, and where there is data which is unreliable, well, we will either discard it or take that into account and make sure that we're concentrating our firepower in the areas where we feel confidence. For example, some of the macro data might be a bit less reliable, but that's okay because we're not macro investors. Conversely, by going and visiting companies and using the disclosed data on their performance, we can be much more comfortable that it is indeed reliable, and that's where we put our clients' money. So it's really being aware of the pitfalls, making sure that you combine the best of a global and a local approach, having boots on the ground. We've also got our joint venture, I should mention, in Shanghai, CIFM, and then just being aware of the problem. So in the same way that China is a volatile market, but if you accept it, then you learn how to deal with it, then for sure some data is patchy, but that's not unique to China. And we focus on the areas where we do have confidence. If you speak Chinese, it's maybe not as bad as you think it is.
Thank you so much, Alex, for sparing time for us today. And thank you for all the answers that you have given here. It would definitely give a lot of comfort to our investors in this fund. Thank you so much. Have a great day.
You take care. Thank you.
Thank you. Hi all, we'll just quickly cover our next fund, which is the US Technology Fund and what's happening in the US. If you see over the last 1 year or beginning of this year specifically, we have seen a lot of volatility in US markets, especially in the tech stock. So what has contributed to the underperformance of the US tech fund is largely the small cap exposure which the fund has and some of the technology names which have corrected, specifically the one which were trading at a higher valuation because the underlying growth was quite high. So two specific reasons for this volatility. One, of course, we have seen US Fed starting to rise rates. And usually when interest rates are rising, there is some bit of volatility in the growth stocks. The second is the perceived, the perception by investors that whenever interest rates hike, usually economy over the longer period of time may not do well. However, what should investors do? If you look at the data going back to maybe in last 2-3 decades, whenever there have been rate hike cycles in US, in fact, there have been 16 rate hike cycles, and on an average, they've been for around 18 months. During this period, S&P 500 has delivered on an average of 13 to 14% returns. Even recently, if you see 2013 to 2017 and 18 specifically, US saw a large rise of interest rates by the US Fed. And during that period, in fact, US markets, specifically the technology stocks, did extremely well compared to any other theme or any other region. So broadly, for US tech investors, we suggest them to stay invested. Of course, when the fund opens for investments, you can top it up and take benefit of the recent correction. How the portfolio is currently positioned for the US tech fund. Largely, the portfolio remains overweight on the semiconductor theme because we all know the structural tailwinds for semiconductor demand is in place. In fact, over the next few years, we'll see more and more demand for semiconductor. So the portfolio remains overweight on semiconductor. It remains overweight on internet businesses. We have seen digitization all over the world. The demand for internet-based businesses and companies all across the world and also in India is on rise. So it remains overweight on internet businesses. However, on the other side, it remains underweight. It has been subsequently underweight to some of the software and software services name because of heightened expectations from these companies. So broadly, this is how the portfolio is positioned. The underlying fund, again, is managed by JP Morgan team who actively manages these team. The US Tech Fund specifically is a fund which rides on expected mega trends and the technology companies. So the team is divided across sectors, across themes, which pick fundamentally strong businesses through a pure bottom-up approach. And we believe that over the next few years, the prospect for US technology as a theme remains very, very strong for these investors and the fund. So thank you so much. In this section, we covered the China and the US Tech Fund, which has been two large funds for our investors who have invested over the last 2 years. And hopefully we have addressed most of your questions. If there are any questions, we'll take them up at the end of this session. We now move towards our next session on our hybrid funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.